great to see at least your picture here and hear your voice. I want to start with the markets in general and Warren Buffett's comments. His comments appear to go against popular wisdom, I think, in how to manage investments. He sold airlines low, didn't buy anything during the historic sell-off. I wonder what you think, from a research perspective, how investors playing at home what they should take away from that.
Well, after having one of the worst months ever in March, April has ended with one of the strongest rallies in about 30 years across a number of benchmarks, the S&P 500, the NASDAQ, and U.S. high grade. So I think that you should expect some consolidation this month. Now, there is just so much liquidity in the system. We estimate that central bank balance sheets are going to expand 17% this year. So you don't bet against that. We still think that you should be, constructive, but consolidation is in order. So the markets responded the fastest, the virus next, and the economy last. And the data prints that we see coming out are still going to be pretty negative here. So I would really look for consolidation, although I do think there's a strong level of support just from the measures that have come out from the central bank and another fiscal package that's likely to go through the Congress in the coming weeks as well.
Okay, we also want to bring in Neuberger Berman's Chief Investment Officer, Joseph Amato. Joseph, good morning.
Good morning. Good to be with you.
Great to see you. So looking at the markets, the S&P is roughly where it was a year ago, though arguably for different reasons. How much would you say the Fed and monetary policy are playing into the levels that we're seeing right now, and what should investors be wary of while factoring that in?
Well, I do think the policy that's been put forth on the monetary side and fiscal side has had a big reason that the markets have moved up, particularly on the Fed side. It's very much been a liquidity-driven bounce back, and I think what you want to be wary of is markets have moved a lot at the large cap level. At the same time, it's very much a two-tiered market. I mean, if you look at what large cap stocks have done, as you said, they're about where they were a year ago. They're down modestly year to date, and given the cataclysmic economic situation that we're in right now, you would think that markets would be down more. But as you get below that very large cap, high quality segment of the market, small cap stocks, for instance, have been hit very hard. Small cap indices are down 25-30% right now, even though large cap quality, if you look at the large cap growth stocks, they're down less than 5% year to date.
Joseph, I want to get your thoughts on the fact that we have seen appetite for investment grade credit in recent weeks. Just saying that based on all of the capital raises we've seen across different industries, and of course that monster offering from Boeing just last week, is that an area that investors should be participating in more? How should they be doing that?
So we are comfortable with the quality segments of the credit market. We think credit actually represents a better risk-adjusted return prospect than large cap equities at this stage. And as you point out, it was a very significant amount of issuance, in fact, a record issuance in May on the investment grade side. We're also comfortable with the higher quality segments of the high yield market. So again, credit we think is a good risk return trade-off.
Joyce, I want to get your thoughts on the tensions that we're seeing between the U.S. and China. They certainly seem to be ratcheting up again. How much is that priced into the market at these levels? And I guess how much is that a risk at a time where already the economic data that's coming in is so poor and there is so much uncertainty?
I think the market is worried that this is going to become an even bigger issue as the elections approach, later in the year. So you've had a number of moves by the Trump administration that involve export controls, mainly aimed at Huawei. You also have a number of reparation bills that have been proposed by members of the Congress on the Republican side. Now, I don't think that these reparation bills are going to go into law, but you can really see that we're moving to a more contentious phase of the U.S.-China relationship. So I think this is going to be with us. I think it could come up more as a campaign issue. It also seems very difficult to meet these phase one trade targets, just given the economic situation around the world right now. So I think that this is something that will actually remain in the headlines and in focus with market participants.
Hey, Joseph, I want to go back to fixed income because I think that's an interesting area that I know you've been thinking a lot about. Given how low rates are, given how little we know about what the shape of the recovery is going to be, any bankruptcies, kind of rocks underwater for some of these businesses, how should investors think about approaching fixed income, investment grade bonds, and how they should be allocated into those?
Well, I still think that you go with the areas.
Sorry, Joyce, that one was for Joseph.
Thanks. Look, I think many investors have taken an approach of just buy what the Fed's buying, and the Fed has moved very, very aggressively to support the credit markets to ensure that credit is flowing, which is really a critical element of the recovery of the economy. But as I said earlier, I think we're comfortable with the corporate credit market. You have both the support that the Fed is providing, plus many of these companies have very durable business models, low levels of financial leverage, and are in a much better position to get through this crisis and come out the other end, in fact, more competitive and stronger and able to generate higher levels of returns. And I think that also plays well in the higher quality segments of high yield, where, again, the companies that have durable business models, that have modest financial leverage, in the case of high yield, are in good shape. So we're comfortable and would be overweight credit at this point as you think about the overall levels of asset allocation.